Structure and fund thesis. It was Ignor Rosenvelt, who's a very, very famous LP, that said, I believe many strategies are the same, and rarely do funds have a truly groundbreaking strategy. So he was a bit pessimistic on fund structure and fund thesis. But if you're going to raise a venture capital fund from external investors, then you'll need a thesis or a structure around your fund. And if you're an angel investor and you want to invest in companies, then it's also a good idea for you to have at least a basic thesis or a basic idea about what kind of companies you want to invest in. Although some people just invest in anything sort of opportunistically, but in the back of your mind, it's always good to have some kind of structure about that. So what will we be talking about in this set of lectures? We'll be talking about why you need a strategy, what that strategy would include, the advantages and disadvantages of a sector-based strategy, geography and stage advantages and disadvantages, and then the advantages or features of a specialist strategy versus a generalist strategy. So what would a typical fund strategy include? You'd be looking at the market opportunity. And some things are big opportunities in Africa, but might not be big opportunities, say, in Luxembourg or in France. So you've got to look at the market opportunity. You've got to look at your competitive advantage. So why you as an angel or why you as a fund manager would be best placed to do that, and what other people are investing in that space, and what's the competition like for deals in that space. Also the fund manager or fund manager's background and relevant expertise. So if you're an FMCG person, for example, you work in Coca-Cola, you know, what expertise do you have that is relevant? And I'm not saying just because you worked in Coca-Cola that you should do food tech, because that might not have a good market opportunity. So you need to think about your expertise in the context of what you want to do with your fund. What's the capital efficiency? What kind of investment cycle? And how are you going to mitigate risks? So some people have sector-based strategies. And like I said, it doesn't mean because you're in Coca-Cola that you definitely have to do food tech. People in Coca-Cola also have experience in logistics, for example, delivery tech, things like this. And, you know, there's a quote here that I made that you don't need to be a meteorologist to know which way the wind is blowing. So expertise matters, but it doesn't mean because you have a certain expertise that that should be the only thing that you invest in. But what are the benefits of having a sector-based strategy? It is, from my personal experience, as well as this quote from the Venture Capital Journal, it's attractive to founders. So founders actually don't want to have to repeat over and over again and explain to you what their business is. All things being equal, a founder will choose specialists over generalists. So if you want to attract certain founders, then it's probably better. One of the key benefits of having a sector specialization is it attracts founders to you. Other advantages and disadvantages, I've just put them all on one slide, of a sector-based strategy are your expertise. You can add more value if you have a sector-based strategy. It's very, very difficult to know everything about everything. But definitely if you have deep expertise, then you might be able to, I said will? No, might be able to add more value than a generalist. Even Tony Elumelu will not tell you that he has more network in agriculture than he does in banking. So a sector specialist probably has more network in the sector that they specialize in rather than everywhere. You can't know everybody. So if you want to bring network to your portfolio companies or the companies that you've invested in, then having a sector-based strategy probably allows you to do that more efficiently because you're in a particular sector. You might also get better access to deal flow. Due diligence will be easier. So I gave the example of Theranos. Theranos was a company that is now bankrupt. And it was a lady in America who was selling a blood testing machine. And she raised close to $1 billion, I think. The company was valued at almost $10 billion. She was profiled as one of the wealthiest women in the world. But the machine didn't work. Now, we specialize in health tech. So during due diligence, of course, we would have asked for validated studies, we would have asked where it had been published, we would have asked the basic questions that anybody that knows anything about healthcare would have asked. But she went to investors that perhaps didn't know anything about what she was doing and just kind of believed it because they didn't know better. And they all lost their money. And it was also a big disaster for the industry. So when you specialize, I think it helps with due diligence as well, particularly in tech, in fields like that, in medtech, in biotech, where it's difficult to be able to quite work out sometimes what's real and what's not. But disadvantages of a sector-based strategy is, what if there's a risk? There's a risk of the whole sector underperforming. What if that happens? What if you're an agri-tech fund that invests in Nigeria and then there's a drought in Nigeria and it kills all the animals and it kills all the plants? I know that would be highly unlikely, but sometimes whole sectors underperform and you're not diversified if you have a solely sector-based strategy. In our case, we invest in health tech and we invest in fintech, and these are counter-cyclical. So health tech is actually counter-cyclical. So usually when banks are doing badly, healthcare does wonderfully. So in COVID, for instance, when everybody's companies, it was an economic recession for most countries, and the entire global economy was doing badly, healthcare was wonderful. So that's how you can mitigate it. You can also mitigate it with geography. And make sure that you're invested in, you might have a sector-based strategy, but across multiple geographies. And then also you can mitigate it by investing in different subsectors. So actually health tech or healthcare is actually quite a wide sector. You've got pharmaceutical manufacturing tech, you've got biotech, you've got wellness tech, you've got exercise tech, you've got all sorts of different things. You've got software, even within one sector. And the same with fintech. You've got payments, you've got digital banking, etc. So even you've got like e-commerce enabling type apps, you've got lending. So even within certain sectors, you still have a lot of subsectors where, the digital banking sector might be doing badly, but that doesn't mean the software as a service for healthcare will be doing badly at the same time. Geography and stage. And this is an interesting quote from the textbook of venture capital that I advise you to get. I'll be referencing it at the end of this talk, but it's called The Business of Venture Capital. And he says in that book that no single element stands out as much as GP expertise. So if you're joining a collective or you are starting a fund, if you're starting a fund, then you need to think about your own expertise. If you're joining a collective, you need to think about the general partner's expertise. Because throughout all the studies that have been done, no single element stands out in venture capital as much as GP expertise. And I'm going to quote some of those studies. So first I'll talk about geography. Why do we think geography? Because when we think geography, we have to talk about or think about the macroeconomic trends in a particular region or a particular country, the size of the middle class, the internet speed, the cost of electricity, the population are all important. And I think that geography, these factors, when you think about America, it shows why America has such a successful venture capital industry and such a successful technology industry, why America is so perfect. Because America has 300 million almost all middle-class people with great access to the internet, who all spend the same currency, who nearly all have access to electricity. So you can see why, and with huge disposable income. So you can see why, certain geographies matter. And then stage. You can do early stage, and we're in early stage. Early stage is riskier, more volatile, plus there are other players. So the competition for deals is, I wouldn't say higher, but there is competition for deals. There are early stage VCs in that space. There are also angels and super angels in that stage. There are even later stage funds that still play in that stage, like a 10 Club, for instance, an e-commerce company raised $40 million for their seed financing. So how do early stage VCs compete with that? So stage is also important when you're thinking about your fund thesis and where you want to play. And because I've spoken about the risks of early stage, you might think that later stage is a better area to play. Later stage might result in lower returns, but it is more stable. However, disruption is coming from opportunity funds. So a lot of the seed funds have opened opportunity funds that give them the right to also put follow-on capital into later stage companies that they've invested in before. So the later stage funds are now on one side fending off opportunity from the seed stage funds, and then on the other side, there's also a trend on the other side of LPs, like the pension funds that I spoke about, like the high net worth individuals that I spoke about, like the family offices and foundations that I've spoken about, now going direct into the startups. Why invest in a fund when you can just invest directly? And that's what they've started doing. So, you know, in later stage funds, they're kind of hustling from both sides. So what about this idea of specialists versus generalists? And this is the last idea that I'll share with you. And this was actually a study done by Paul Gompers, Anna Kovner, and Joss Lerner. And what they found out in their study is that there's a strong positive relationship between the degree of specialization by individuals at the fund or in the firm and a firm's success. So the more specialized the people, the individuals in the firm are in a particular area, the more successful the fund is likely to be. They also found that a specialist investment professional at a specialist firm will outperform a generalist. And the third thing that I brought out from their study is that specialists are superior when it comes to early stage investments. So imagine if you had a specialist practitioner that specialized in a particular area, who also had entrepreneurial experience, maybe had started a company in that sector, for instance, and that company had done very well, and also had domain expertise. So also had expertise both from an academic perspective and from a practical investment perspective in the sector that they were investing in. Wouldn't that be a great person to invest alongside? I'm not mentioning any names, or I'm just saying. So yeah, this is the evidence and this has been proven out over multiple studies of venture capital and venture capital practitioners over time. So I think that that's giving you an overview of some of the things to think about when you're thinking about your fund thesis, when you're thinking about fund structure, and when you're thinking about the decisions as to the geography, the stage, and of course, the sector or sectors that you choose to invest in. And this is the book that most of this came from. It's called The Business of Venture Capital. I've mentioned it several times, and it's by Mahendra Ramsinghani. Thank you very much.